Craig, Chief of Staff, Deputy Clerk, Administrative Staff, Madam Treasurer. Today is Monday, July 8th, 2024, and this is the City of Romulus City Council Special Meeting Study Session, and this meeting is to discuss the quarterly investment report. And at this time, we'll have a roll call. Councilwoman Abdo. Here. Councilman Barton is excused this evening. Councilwoman Roscoe. Here. Councilwoman Talley. Here. Councilman Wadsworth.
Here.
Councilwoman Williams. Here. And Councilman Wilson.
Here.
Madam Chair, we have a quorum for tonight's special study session meeting. The special meeting agenda is as follows. Number 1, roll call. 2, agenda. 3, discussion. The quarterly investment report. 4, public comment. And number 5, adjournment. And a motion would be in order to accept the special meeting agenda as presented.
So moved to accept the special meeting agenda as presented.
Support.
Motion made by Councilwoman Talley to accept the agenda as presented. Second by Councilwoman Abdo. Councilwoman Talley?
Yes.
Councilwoman Abdo?
Yes.
Councilwoman Celeste Roscoe?
Yes.
Councilman Wilson?
Yes.
And Councilman Wadsworth?
Yes.
Chair votes yes.
Thank you. This motion is carried. Number 3 is discussion of the quarterly investment report. And to lead us in the discussion is our City Treasurer, Stacy Page.
Thank you so much, and thank you, Council, Mayor, Chief of Staff, Clerk, Deputy Clerk, and listening audience. This evening, we are doing our quarterly report ending March 31st, 2024, and I have Gray Lepley here. She is our investment manager for PFM. As you remember, Brian Quinn, occasionally, probably once a year, you would see him and he would do the quarterly report. He has since retired. And we have the lovely Miss Gray here, and she's going to go ahead and take it at this point and share the quarterly report with you. Please, I encourage you to ask questions. Thank you.
Thank you. Can everyone hear me okay?
Yes.
Okay, fantastic. So just a brief introduction of myself and why I'm here, other than the fact that I'm taking over for Brian, who retired and is sailing off into the sunset, literally. I have been working at PFM Asset Management for 9 years. I started as an analyst, have moved up the rungs quite a bit, and now I had been a portfolio strategist working with some of our largest clients across the country. So I had more of a national focus, and now I'm going to have more of a Michigan focus. So that is what I'm in charge of our Michigan client base in general. So anyway, I met Stacy probably December for the first time. So we've been in contact for quite some time and had a few introductions and all of those things. So, but as I'm going through this report, please feel free to interrupt and interject. I'm happy to have this be more of a dialogue if that's what you're interested in than me just doing a monologue the whole time, which I can do and have been known to do in the past. So starting with the report, I'm not going to go through this page, this current market themes page, because you can all read this at your own leisure, and if you want to, it's good late night reading for when you're trying to fall asleep. But the next page gives you an idea as to what happened over the past quarter for this quarter, ended March 31st. So I'm going to try to keep it a little bit more pertinent since we're obviously in July at this point. But essentially what happened during that first quarter was this discussion about what are we going to do in terms of the Fed? What is the Fed actually going to do with rates? Are we going to see them start to cut rates? Or are they going to keep rates higher? And it's really because of the inflation story, right? Inflation has been remarkably high for quite some time. And you can see that here on this page. It peaked out at over 9% in June of 2022. What I'm showing here is CPI. So this is a consumer price index. This is really the headline inflation that people hear the most about. When you're talking about inflation or hearing the news about inflation, it's typically this metric of inflation that you're hearing. And what we're showing here are the expectations in the dotted blue line versus the actual numbers that had been coming in for quite some time. And you can see that over the past few readings, we had seen expectations really be lower than what the ending inflation number actually came in at. So what does that matter? It matters because we were expecting inflation to abate more than it actually had. And so because of that, the Fed was in a position where they decided, maybe we're not going to see as many rate cuts as we had originally anticipated this year. Going into 2024, there was an expectation that we might see as many as 7 rate cuts for the year. Now that's gone down to about 2. And that's really because we've continued to see this really high inflation number. So we are going to get inflation reading this Wednesday. So if you want to put that on your calendars, 8:30 in the morning, there should be an inflation reading. The expectation is that that's going to come in somewhere around 3.3%, somewhere in that range. If you take out the volatile components of food and energy, which tend to kind of move around a lot, the inflation, the core inflation reading is expected to be about 3.4%, which is in line with where it was this past month as well. So that means that we have seen some progress moving back down to that 2% target. That's what the Federal Reserve inflation target is at the bottom there in that green. It's 2%. So we're still well above that, but we have made quite some progress in terms of where we have it. The next part of what the Fed thinks about, and the Fed really does drive what we're doing in terms of investments, is the labor market. They have a dual mandate of keeping inflation under control, as well as making sure that we are at full employment, or close to full employment in terms of the labor market. So the most recent information, if you look in the bottom left, you can see the unemployment rate at 3.8%. Most recently, this past Friday, it came in at 4.05%, so rounds up to 4.1%. So there has been some softening in the labor market for sure. And the Fed's actually been quite happy about this. They want to see some softening in the labor market so that we are not in a situation where there's many more jobs available than there are people actually looking for work. And that's shown on the right-hand side of this page. So you can see at the time when we put this together, the gap between the amount of jobs versus the amount of people looking for work was 2.3 million. That has since come down below 2 million. So we're getting back into better balance, but we're still not back to where the Fed wants us to be in terms of that labor gap. And one of the reasons this is really important is because when you're looking at wage growth, that spurs on inflation, right? If you think about services here in the US, we're a service-driven economy, and when our wages are higher, and significantly higher than they had been, that's going to push into services costs, that's going to push into overall inflation numbers. So wanting to get this labor market under control to a certain extent is going to help with inflation as well. Briefly, what's going on with GDP and the overall economic picture? We had seen very strong numbers in the third quarter and fourth quarter of last year. The first quarter was expected to come in, you can see from this page when we put it together, was expected to come in somewhere between 2 and 2.5% economic growth. It came in lower than that, around 1.5% is where it ended up. That was a pretty big miss, but when you look into the numbers a little bit, one of the most important things that really is the bedrock of the economy here in the US is consumer spending. And that continues to be quite strong. Maybe not as strong as it had been in the third and fourth quarter of last year, but still quite strong. Looking forward to this quarter, second quarter, we haven't gotten those numbers yet, but the expectations based on different models that are out there is 1.5% growth. So if we think about this contextually and think back to pre-pandemic, 1.5% growth on a quarterly basis or an annual basis was pretty much in line with where we had been for quite some time. So this is not outside the realm of what's normal. What is abnormal were those 2 quarters where we saw 4.9 and 3.4% growth. So expectations are not that we're going to continue to see that. We're going to see some sort of a pullback, and you're starting to see that to a certain extent. So as a result, the theme for the quarter really was higher for longer. I want to break down this page for a second here. What we're showing is in the light blue at the bottom, that line is basically where did the market expect interest rates were going to go over the next few years as of December. So in December, 6 months ago now, the expectation again, like I said, was that there were going to be 6 or 7 rate cuts. And so rates had really fallen pretty significantly as a result of that expectation. What we've seen since then, and you can see that the March line is the dark blue line there, it's gone up quite a bit, right? So expectations are that rates are going to be higher for longer. That's really the theme here for this quarter, was higher for longer, because of the fact that they hadn't seen enough inflation progress at the time when we put all of this together. So if I were to bring this forward to you, for you to today, and to show you where interest rates are as of today, another line, it would be very similar to what you're seeing here for the dark blue line. So not a much of a change over the past few months, just because of the fact that we've continued to see kind of the same steady place in terms of inflation and unemployment. I'm going to skip this page. Go on to this page. This is the dot plot. I'm not going to belabor this too much, but really what this shows is what is the Fed expecting for interest rates. When they put this together in March, the expectation was that there would be 2 cuts or 3 cuts for 2024. Then when we had an updated version come out in June, just a few weeks ago, they took that back and said we only think there's going to be 1 rate cut. What does that mean for you and your portfolio? That means that interest rates are higher. That means that you're going to get these higher interest rates for longer. And we're going to talk about a transition that we've been making over the past quarter or so, and to kind of talk about how we were able to capitalize on that recently. As you can see, though, as you go further out the curve into 25, 26, and then longer term, the Fed does expect rates to go down. So long term, do they think that we're going to be in a zero interest rate environment like we were for many, many years during the 2010s and right after the pandemic? The answer is no. They expect overnight rates to be somewhere in that 2.5% to 3% range on a regular basis going forward. So they think that that was an anomaly and that we're not going to go back to that. Let's go to this page. So what happened with interest rates across the board, especially where we're invested on your behalf, which is that 0 to 3 year space as of March 31st. You can see that the dotted line to the solid line, we saw rates move up. When you see rates move up in bonds, that typically means there's a market value decrease. So when yields go up, market values typically go down. So what you would assume would happen as interest rates go up is that you're going to see negative performance in the portfolio. We're going to get to that in a moment, and I'm going to show you what the actual performance numbers look like. They were very strong, and they're not negative, and I'll explain why that is in a few minutes. I'm going to skip over these pages. Here is a snapshot of what returns in the 1 to 3 year space looked like. For you all, we're not invested in the pink, the yellow, and the orange. Those are corporates. Those are not permitted by Public Act 20 and not permitted by your investment policy. So really what we're looking at on this page, specific to you, is where did treasuries come in for the quarter? How much of a return did they produce? As well as agencies. We have other types of securities in there as well, such as supranationals in the portfolio, which we'll talk about in a moment. But suffice it to say that both of these had positive returns for the quarter. Even though we saw interest rates move up, they were positive because the yield that you're getting on those securities is so high, it's compensating for that change in market value that we saw. So again, getting these yields of 4.5%, 5% is so beneficial that it's actually outweighed any change in market value that we saw over the quarter. And then over longer periods of time, as you can see over the past year, very strong returns too. So when we get to the portfolios itself, just keep these numbers in mind because we're in a good spot with that. I'm not going to talk about all this. We kind of went over these things, but if you have any questions, feel free to interject. And last thing I want to talk about in this section before we get to the portfolio itself is the sector outlook. Now, a lot of these are not permitted, again, per Public Act 20, per your investment policy, but the things that are permitted, let's talk about those briefly. Commercial paper at the top there, that's short-term credit. So think of that as Bank of America going out and borrowing money on a short-term basis. That would be commercial paper. So that might be a name that we would own if they were permitted and if they met the right requirements for credit ratings. That is a little bit more attractive. If you look at the circles, you'll see last quarter is the hollow circle. Now is the filled-in circle. So it's a little bit more attractive than it was about a quarter ago. If you look down the list, though, you'll notice that most things are less attractive. So across the board, you might say, well, where is the value in these sectors right now? And the answer really is it's on a very selected basis. So we're scouring the markets, finding opportunities where they're presenting themselves. And I'm going to get into that a little bit when we talk about the transition that we've done in the portfolio. Before I move into the portfolio itself, does anyone have any questions, comments, etc.? Okay. So getting into the portfolio, this is all of the bank deposits and investments and security types, maturity distribution for the city. So this is not just what PFM Asset Management is managing, it's also other outside bank deposits, other managers, et cetera. So you can see that a lot of the money on purpose is really below that 6-month mark, and that's really to continue to keep things liquid, is to be able to take advantage of the fact that interest rates have continued to be very high on the front end of the curve, right, at that 5.25% to 5.5% range. But as a result of the fact that we do expect interest rates to start falling, one of the things that we've been working with Stacy on is trying to put more money further out the curve. So I was telling you about the 0 to 3 year space previously. That's really where we had been investing. We've now changed that to a 0 to 5 year. So now you're going to see more and more investments in that 3 to 5 year space than you had before. So just keep that in mind as we look at future reports that that's going to be the case. In terms of the different types of securities, you can see all of them here, very well diversified across the board. You have federal agencies, treasuries, municipals, commercial paper, as I've discussed, and a lot of money in overnight liquidity vehicles, such as GovMIC, such as money market funds. And this goes back and shows you the difference between this year and last year. The one thing you'll notice here is GovMIC balance as of March 31st was about 10 million. That is the overnight local government investment pool that PFMAM manages. The reason that that's at 10 million and not at 2 or 0 or somewhere in that range is because we were about to start investing in that 3 to 5 year space at that point. So we were getting ready to do that. So that money is no longer in GovMIC. The GovMIC balance is much lower than that now because we've started to invest in securities. And credit quality, again, very high credit quality across the board. Again, AAA rated or AA rated. The AA plus, you probably already know this, but the US government was downgraded in 2011 and then again by a different rating agency last year, I think. And so they are now rated AA. So not as high as some of the other types of securities that are out there. So if you're looking at it 35% saying, well, what is that? That's really where that's coming from. Any questions on the overall picture before I get into PFMAM's portion itself?
Yeah, through the chair. Councilwoman.
Yes, sorry.
Just a quick question. When you were talking about the investment balances, you're going to invest it in the securities, correct?
Yes.
Is that our normal practice?
Yes, it is.
Okay, and I'm sorry, and probably before, what type of security?
No, they have great question. So what's permitted by your policy are U.S. Treasuries,
Okay,
federal agency securities. So when I'm talking about federal agencies, I'm talking about Fannie Mae, Freddie Mac, Federal Home Loan Bank, which are government, not government guaranteed, but are government guaranteed adjacent, meaning that those entities essentially have the backing of the U.S. government, as we saw during the 2008 credit crisis, et cetera. So as a result of that, they're all very highly rated. They're all very highly liquid as well. So if we needed to sell out, for instance, of a 5-year security because there was an unforeseen cash need, we could easily do that day of. So
yeah,
there'd be
and
no issue.
that is our normal practice. I just wanted to verify.
Yes,
So
that is
thank you.
correct.
No,
Yeah,
thank you.
absolutely.
I appreciate it.
Yep. Any other questions before I continue? Okay. So as we get into this, again, you're going to notice at the top here, the total market value of about $35 million for our portion that we manage by PFMAM. The managed account subtotal, which is just securities, is about $25 million as of the end of March. And again, you can see that pool amount of $10 million. So that pool amount is now gone and is now invested in securities, as I mentioned. So it looks very similar to what you're seeing on the right-hand side in terms of sector allocation. Just take out that brown section, which is the local government investment pool, that liquid money, and essentially we're invested in all of those different types of securities still. So again, treasuries, agencies, commercial paper, supranationals, all of those types of things. Credit quality, very highly rated. One thing I do want to point out is yield at cost at a 407 versus yield at market at 497. That's in the top left. That yield at market is essentially saying if we were to buy your entire portfolio again today, just reconstitute a new portfolio, what would we have purchased it? What would the yield on that portfolio have been? It would have been a 497. The fact that the yield at cost is a 407, honestly, is pretty fantastic because we purchased these securities over time. And so we purchased some securities when interest rates were still 0, purchased some securities when interest rates were near 2, now we're near 5. So we blend all of that together, and what you get is that 407. You're going to see that that's going to improve even more when we look at this quarter's report that ended 6/30 because of the fact that we've purchased securities in that 3 to 5 year space. So we've really been able to add really attractive yields. Here's the issuer diversification by sector. And one of the most important things for us is keeping issuer names as diversified as possible. So when you're looking specifically at commercial paper, I talked about that being short-term credit. If you look at those and you look at the actual percentages of any of them, the highest we have in there is Barclays at 4.2%. We try to keep that as diversified as possible. So you will never see that go above 5%, for instance, in any one name. And that's really to keep you in a place where we're mitigating credit risk on your behalf. So that's an important aspect of what we do. And then you can see that there's a lot of other sectors in there as well, a lot of them agency related, as I mentioned before. Here's the change for the past 4 quarters. You'll see again that big brown section. That's the LGIP, that's GovMIC, which we've now invested out of, so divested from, and now invested in securities. So that's why you're seeing that there. So the balance in the portfolio as of now is about $35 million as well. And again, we'll talk about the transition in just a second. But you can see the change over the past 4 quarters in this page. So here I wanted to talk about some trades. Commercial paper was one of the things that we continued to purchase during the first quarter. Treasuries, we continued to purchase as well. You can see supranationals, there was a little bit of a sale or a maturity in that space that we did not reinvest. What we have done with the excess money, the $10 million though, has been to purchase primarily treasuries initially because they are so liquid, because they are so available and at really high yields right now. And as we see value in other sectors like federal agencies, supranationals, commercial paper, things of that nature, we're putting that money to work. So when we first initially purchased securities, they were all treasuries. Now we've started to piecemeal move into some of the other sectors that are available out there that are creating value in the portfolio. We didn't want to say, put 20% of the new money all at once into agency commercial mortgage-backed securities or supranationals or wherever it may be, because that wasn't allowing us to really take advantage of relative value. That would mean that we were just taking advantage of what was available that day. So again, when we look at next quarter, you'll see that there's been a lot of changes in terms of the trades that we've made. So here's the good news. For the past 3 months, you can see total portfolio return of 66 basis points, so 0.66%, versus the benchmark, which again is that 0 to 3 year treasury at 58 basis points, so outperformance of 8 basis points just for the quarter. If you look back over the past year, though, you can see that that's significantly higher at 398 versus the 368 of the benchmark, so about 30 basis points of a difference. Going back all the way over to the right-hand side over the past 10 years, we have had on an average basis 13 basis points of outperformance every single year. So really positive performance. We're really proud of the numbers that we're showing here, and we expect this is going to continue as we move forward. I can't guarantee that we're going to see positive performance every single quarter, but I think that the value is very apparent here. The one thing I will mention, though, is that interest earned portion, $198,000 up at the top under market value basis earnings. That's how much money was actually earned from coupons coming in during this quarter. That's going to continue to grow because interest rates are so high and because we've been investing in these high interest rates. So that change in market value where interest rates moved up and we saw market values fall was much lower than the overall interest earnings that you had in your portfolio. I'm going to skip this page and go to this page, accrual basis earnings. In the chart at the bottom, you'll see the interest earned is the same at $198,000. You see the realized gains or losses in this case of $55,000, but then change in amortized cost of $80,000. So in terms of total accrual basis earnings for the quarter, it was about $216,000. Over the past year, over $650,000. And over the past 10 years, over $3 million in terms of total accrual basis earnings. So really strong performance. You'll see that as we go forward, that the slope of the line with the accrual basis earnings has kind of taken off to a certain extent. And again, that's because of the fact that we're investing at these higher yields. So as long as yields continue to be high, we expect that to continue to move in that direction. The rest of this, again, late night reading, or whatever issuer distribution, transactions, all kinds of other information. So if you do have any further questions after I've left, feel free to let Stacy know and she'll get in touch with me and we can absolutely answer those questions. But since I'm still here, anyone have any further questions for me?
No? Any questions?
Okay, great. Well, it's nice to meet you all.
Thank you.
Look forward to working with you.
Thank you.
Thank you.
Good job.
Thank
you.
Thank
Good job.
you.
Are there any final remarks from the city treasurer while we're still under discussion?
I just want to thank you again for coming out. I appreciate it, and she did an amazing job, as always. And I had spoke with you about the 10 million. We had talked about that in the last quarterly report. We wanted to lock in some of those rates long-term because we anticipate that the rates are going to fall. So they're doing a great job, and they're great to work with, so thank you again.
Thank you, Madam Treasurer. On the agenda calls for public comment, and this is a portion of the agenda for those who are in the audience and would like to address the City Council regarding tonight's special meeting agenda. To do so, please raise your hand, and after being acknowledged by our chairperson, approach the podium and state your name. You will have 3 minutes to speak, and any additional time will be upon the consent of the chairperson. And Madam Chair, I don't see anyone from the audience requesting to speak.
Close that out.
All right. So noted. We're going to move on to number 5, which is adjournment. The motion will be in order.
So moved.
Support.
Motion by Councilman Wadsworth, supported by Councilwoman Abdo. Roll call vote. Councilman Wadsworth?
Yes.
Councilwoman Abdo?
Yes.
Councilwoman Celeste?
Yes.
Councilwoman Tina Talley?
Yes.
Councilman Wilson?
Yes.
Chair votes yes.
Thank you.
This meeting's adjourned, and our